This conference will now be recorded.
Hey, hi everybody. My name is Anil. I will be your instructor for next 2 hours for the credit risk topic. So, are you guys able to hear me? Just ping me, reply me on the chat. I have muted you all. So, in order to avoid the disturbances, I have muted you. Just ping me on the chat whether you are able to hear me or do I need to adjust my microphone. Okay. Okay. Thanks, Rupesh. Thanks, Sandy. So, let us begin. So, congratulations on passing your FRM part 1. I think I assume uh, you have cleared your part 1 and you must have registered for part 2 for your May exams. So, going forward in FRM part 2, from right now, you must have understood the difficulty level of the FRM syllabus. So, so FRM part 1 was more on the quantitative side. So part two is mostly into the current applications which would be applicable in the industries. So part two basically includes credit risk, market risk, operational risk, and similar to part one, like current financial uh, issues and topics. So for this class, I will be covering you the credit risk measurement and management. So this is one of the main topic in the part two, and it has almost equal weightage compared to the other subjects also. So let us begin. So just to give you a basic introduction on the credit risk. Uh, so credit risk is basically, uh, if you say, it's a likelihood or it's a probability that any counterparty or any party will be defaulting. So you can say the credit risk is how credit risk is different from the market risk events are. Credit risk is basically depending upon the credit events, if the counterparty or the other party has some downgrading of his credit ratings, or he is not willing to fulfill his obligations, or any other reasons depending upon the counterparty will result into the credit risk. So in order to distinguish it from the market risk, as I say, can be basically due to the events of market risk, such as change in interest rate or any changes in prices due to similar to the event during the 2007 financial crisis. So it impacted across all the banks and across all the participants. So, so that such events cannot affect individual parties or any individual financial institution, but it comes across each and every institution. So such events can be classified as market risk. So similarly, the credit risks are mostly related to the events to the single parties or the party which you are having obligation with or you are having exposures. So again, going forward, so how do you measure a credit risk event? How do you understand the credit risk? Then what are the basic terminologies used in the credit risk uh, events? Such things we will cover in this uh, topic. So the very first basic terminology for measuring the credit risk is the expected loss and the unexpected loss. So if I want expected loss is very simple and it can be easily quantified. The unexpected loss is more related to the probability of defaulting. So that is little bit complex and we can go in further topics also we will be covering that how to measure the credit risk through the credit default. So the simple measure for measuring credit risk is the expected loss, and for the given uh, calculation of expected loss, I can calculate it through probability of default, exposure at default, and loss given default. So these three main terminologies I will explain you each and everyone. So just to give you an example, how this expected loss is calculated. Say a bank A, or so bank A named the Citibank, let us name the bank as Citibank. So if this Citibank is having a loan exposure, a simple example would be, say a Citibank has given to a loan to Barclays Bank for almost of 100 million. So, so I can say, so a loan of 100 million will be will state is as an exposure. So in order to understand the credit risk, so what Citibank risk managers will do is they will try to quantify this exposure. So the simple principal amount is 100 million loan. So they will simply classify this as an exposure. Then apart from that, he has lended this loan to the Barclays Bank. So they will try to quantify what will be the probability of default of the Barclays Bank. So they can quantify the probability of default of Barclays Bank through its credit ratings or the financial health of the Barclays Bank. And there are various other parameters for quantifying and measuring the probability of default. There are external institutions also which publishes the probability default for each and every financial institutions also. So so once the risk manager knows the exposures, he knows the probability of default, then he will try to quantify the loss given default also. So, so what exactly is the probability of default? Probability of default is like over the specified period of time, what is the likelihood or what are the chances that the Barclays Bank would default? Say, let us assume for the Barclays Bank, the probability of default is 10%. As I said, then the exposure for that particular loan was 100 million. So again, the second terminology, which is exposure at default, would be the given the principal amount of 100 million, then in the event of any crisis or any credit event, say the Barclays Bank is likely to go bankrupt or it is going to default on the obligation of for this particular loan, then at that particular time, what would be my exposure? So exposure would keep on changing over the period of time. Say since I have given loan to the Barclays Bank, then over a period of time, the Barclays Bank would be repaying and paying some interest and the principal amount. So, so over the period of time, say now the exposure has come to say 70 billion, and now currently after like 1 year or 2 years, now the Barclays Bank financial health is very poor and it is going to get default. So at that particular time, my exposure is 70 million, and my risk manager would say like my current uh, exposure with Barclays Bank is 70 million, and we can say that the exposure at default is currently 70 million. So another terminology is the loss given default. So if I am having an exposure of 70 million with Barclays Bank, so it is not all and likelihood saying that I will be losing all the 70 million. If due to bankruptcy laws and other other laws, we the Citibank would not be facing all the loss of 70 million. So there would be certain part where the Citibank would be able to recover from the Barclays Bank, and that we will be defining as the recovery rate, or I can say my loss given default if the Barclays Bank is defaulting is say 10 million. So in all, I would be recovering him from the Barclays Bank almost 60 million, and my like, even though my exposure is 70 million, I would be facing the loss of only 10 million, and I would be recovering 60 million from 60 million of the my principal amount from the Barclays Bank. So once I get this all this parameter, so I would be simply calculating my expected loss as probability of default, that is 10%, multiplied by my, this is 1 minus recovery rate. Recovery rate is mentioned in terms of percentage. So in this case, my recovery rate would be almost 90%. So 1 minus recovery rate would be exposure at default only, and that would be 70 million. And this this is uh, this is like a simple calculation formula for the expected loss. So this would be giving you a simple uh, quantifying measure for uh, your calculating your credit risk. So apart from the expected loss, we have unexpected loss, which we will be covering further in the coming topics. So far, I will take a simple example also for this particular topic. So till now it is clear, right? So just ping me on the chat if you have any doubts for this topic. Okay, thanks, Sandy. Okay, moving on to next topic. Okay, let us take an example question from this is a question from this wager only. So let us take and try to solve this. So I will just read out the question and just ping your answer on the chat. During a conversation about the credit risk, a colleague mentioned that the typical measures of default risk is probability of default over a 1 year horizon, because the overnight lending has a zero probability of default. So related to this question, we have again four options. Say is correct with respect to both statements. She is correct with respect to default risk. Say is correct with respect to overnight lending, and says either not correct in any of this statement. So just take a 1 minute and just try to answer this question. Just type your answer in the chat. So just to give you again, just to give you an overview of the previous terminologies which I had just told you. So probability of default is just an event or a chance or a likelihood that a particular financial institution or particular counterparty is going to default. So basically the probability of default is measured over a period of time. So this has to be measured for each and every institution. So if the institution is having an exposure in repos, if it is having an exposure in credit default swaps, or any cross currency swap, or any of the instruments or any of the transactions, for each and every institution, the probability of default, and for each and every transaction, the probability of default will be calculated. Okay. So we have one more. Uh, I think Rupesh is also there. Rupesh, so what is your answer? Okay. Yeah. Okay. Right. So the correct answer is option B only. So if I say, so this probability of default is measured, as I said, is measured over a period of time. So okay, let us go by each and every uh, options, and let us try to eliminate each and every option. So the option C is correct with respect to overnight lending. So this overnight lending is related to the repos transactions, and this we cannot say that for any of the transactions the probability of default can be zero. Even though it is for the overnight also, there is very few chances of the repos are basically the cash transactions only. They are very highly liquid in nature. So banks undergo the repos transactions just to just to maintain their cash balances, and their the credit ratings for them is also very high, and they are very highly liquid. So even though it is such a good cash instrument, but still the probability of default of any instrument cannot be zero. There are no instrument for which the probability of default is zero. It can be through any event. Because of any such event, the probably there will be a certain, even it will be a 0.02 or a 0.001. There will be always be a probability of it. So we can eliminate the option C. So the remaining option is she is not correct with respect to the either of the statement, which we also can eliminate, because the correct option is B, which is the probability default or the default risk is measured over a period of time. Say one. Okay, so let us move on to the next topic. So this is basically I had covered the basic terminologies and simple question which for the credit risk, but do not expect such easy questions to come in exams. Obviously, there would be a much difficult on a higher difficulty level, and on more complexity you will be encountering the questions. So further we will be covering the topic of counterparty risk measurement, then how the counterparty risk is different from the lending risk. So again, in credit risk, there are very different types of risk. It can be you can say a default risk. It can be an exposure risk. It can be a lending risk. But the main type of the credit risk is the counterparty risk. So counterparty risk, the simple definition is how if you are having an exposure of a loan, if you are having a transaction, if you have entered into a trade, a swap trade with other party, so the likelihood or the event, uh, any occurrence of credit events for which the counterparty or the other party would not fulfill its obligation, the risk of that, it can be classified as counterparty. So going forward, we will see how what is basically counterparty, how it is different from lending risk, how we can measure a counterparty risk, then what are the other terminologies and uh, other requirements to measure the counterparty risk, and how we can try to measure and how we can try to mitigate the counterparty risk. So the first topic is how it is different from the lending risk. So if I say the lending risk, in my previous example, say in which the Citibank has given the loan to Barclays Bank of almost 100 million. So in that case, so the lending risk is basically the principal amount only, and which can be easily quantified and which can be easily measured also. And lending risk is basically one way. It is so the lending risk is defined for the Citibank, which is having Citibank is having the lending risk with respect to the Barclays Bank. So let me type it here, the example now. So simple Citibank has given an 100 million loan to Barclays Bank. So this is kind of an one-way risk in which the Citibank is facing the lending risk. So now, if I give you another example, say Citibank has entered into a swap transaction of almost say 100 million with Barclays Bank. So if you have a little bit information of what is a swap product and how does it work, so it is basically it's a swap work. Both the banks will be having an exposure at a particular point of time. So you guys are aware of these swap products, or do you want me to explain a little? Want you to give me a brief about what is a swap product?
No,
You
we
can
are
just
good
ping
with
on
swap.
the chat. Okay. So I have muted all the. I think I muted Rupesh also. I was I was able to hear some background noise from Rupesh. So Rupesh, like going forward, if you have some doubts or any clarification regard, just ping on the chat. So this would be the protocol which we will be following for the uh, whole session. Okay. So in the first example, I told you this Citibank is facing a simple lending risk, and in the second example, the Citibank and both Barclays Bank will be having a counterparty risk. So say if and after 1 year of the soft transaction, each and every so Citibank would be quantifying its exposure. So for that particular point of time, the Citibank is in positive exposure, and say currently the Citibank is having in 20 million exposure to Barclays, and similarly, there would be an opposite exposure of negative 20 million from Barclays. So now in this case, the Citibank, since he is having a positive exposure, he would be facing a counterparty risk from the Barclays Bank. Then again, say after one more year, the exposure has changed, and due to the change in interest rate, now there is a negative exposure of say 30 million, and similarly the Barclays Bank would be having the positive 30. So now after the 2 year of period, the Barclays Bank is having an counterparty risk with risk for Citibank. So just to differentiate between the both example, the counterparty risk can be both ways. But in the above example of the say of the loan, there is only one unilateral or say one way risk which we can define through lending risk. So this is very important to understand the counterparty risk, because before the 2007 financial crisis, nobody was sure of how to measure and counterparty risk. So this term was very one of the key findings of the recession, and one of the key findings to for the risk management development also. So again, just to differentiate, this is counterparty is bilateral, lending is unilateral. The counterparty risk is the you cannot easily say, measure the counterparty risk in terms of exposure, because the counterparty risk involves the futures transactions, so the futures exposures also. Say what would be happening after the 2 year time period, what would be happening after the 3 years, because eventually the swap values and the swap transactions would be it will be keep on changing, and each and every counterparty would be having different exposures in the given future. So the measuring of the exposure through the of the each and counterparty is little bit difficult compared to in the lending risk. So let us take an example for this topic and try to understand more deeper into this. So I will just read out the question. You can just type your answer uh, in the chat. So consider the following options. So lending risk is a type of credit risk, but counterparty is a type of market risk. Lending exposure is predictable, but the counterparty is highly uncertain. Lending risk is unilateral, counterparty is bilateral. Then the fourth option is lending risk arises due to inability to meet the obligation, but the counterparty depends upon the market variables. Lending risk cannot be quantified, but counterparty risk is easy to be quantified. Just take 1 or 2 minutes of time and try to ping your answer. Okay, Sandy, do you require more time or shall we proceed? Okay. Okay, let us take each and every option and try to eliminate each and every option. So the first is lending risk is a type of credit risk, but the counterparty is this is not true because both of the type of risk comes under the credit risk concept. So the first option is eliminated. Then the second option, lending exposure is somewhat predictable, but counterparty credit risk is some highly uncertain. So this is correct. As I gave you the example of swap, it is very difficult to measure the future exposure of each and every transactions, and based on that to ascertain the counterparty risk is also little bit difficult. The third option is lending risk is unilateral, but the counterparty this is true. So 2 and 3 are true. Let's go to the fourth option. Fourth option is lending risk arises due to obligors inability to meet the contractual obligation, but the counterparty risk arises due to the market variable. So this is also not true. This is somewhat uh, kind of uncontradictory. So counterparty risk is mostly related to the individual ability or the financial institution ability to repay or to meet its obligation. So the fifth option is lending risk cannot be easily quantified, but the counterparty risk is straightforward. This is also not. So the correct option is B. Okay. So till now it is clear, right? Let us move on to the next topic. So now as we have understood the difference between the lending risk and counterparty risk, let us try to understand in which of the transactions we have the counterparty risk. So majority of the transactions comes on the OTC market. So first of all, let me give you a brief about what is an OTC market and what are the exchange traded market. So in the OTC market, it's basically the over the counter market in which you can enter into a transaction with any counterparty, and you can almost customize your transaction or your contracts or your ISDA agreement. You can easily you can negotiate, and you can easily try to amend also. So basically in OTC markets, we don't have any central counterpart. So the other counterpart of the OTC market is the exchange traded products. So again in OTC you will be having the different, you can have repos, you can have swaps, you can have bonds. Then there are n number of products in OTC market also. Similarly, you have the same products in the exchange traded also. The only difference is in exchange traded, you will be getting a standardized contract. So you will be not be able to try to modify or try to amend your contract. Say if I give you a simple example of any forward contract, so you can have a forward contracts in an OTC market, but a forward contract in exchange would be a future. Basically, a forward contract is stated as a future contract in an exchange traded environment. So basically, and future would be a standardized contract similar to the forward also. So the underlying concept of both the forward and the future would be same. So since we are you would in the exchange traded, you would be not be knowing who is the counterparty, because you will be having exchange would be having a clearing house which will be acting as a central clearing party. So again, in OTC markets, the you would be knowing your counterparty. Say the Citibank is one party and the other party is the Barclays. So you would be knowing the other counterparty and its financial health and other details to enter into the ISDA agreement in the OTC markets. But you would be not be knowing such information in the exchange exchange traded market. So basically, now we need to quantify such transactions as any transactions which we are at while entering into swap. Whenever the dealers are entering into the swap, whenever they are transacting in the repos, we need to first basically classify whether these are the exchange traded or whether they are traded on OTC. So accordingly, the risk manager would be try to try to measure the counterparty risk mostly for the OTC markets. So why do we have the counterparty risk in the OTC market only, and why we don't have the counterparty risk in the exchange trade? So the main issue, or the main what do you say, the main purpose of exchange traded is to introduce a central clearing party which will eliminate the credit risk or the counterparty risk. So in exchange traded, the central clearing party try to will try to guarantee the fulfillment of the obligation. So there cannot be there cannot be a chances of default or due to any other credit events. You will be not be facing any default, or the other party is not fulfilling its obligation, because in that case the exchange is taking the whole and sole responsibility of meeting your obligation. So say there is an party A and B, which they are entering into a swap transaction which is traded on exchange, then or any future transactions which is traded on exchange. And in such a case, the both the exchange clearing party will try to fulfill the obligation for both party A and B. Say for any of the reason B has defaulted, then only then also the exchange would be paying or fulfilling the obligation to the counterparty A. But this doesn't happen in case of an OTC traded instrument. So, so in order to so what does the risk manager do in order to avoid such risk? So what he would do such OTC transactions, he will try to measure the financial health of the counterparty. Then there are techniques to mitigate such risk through netting, through collateral, uh, through multilateral rating, which we will be covering in further slides. So, so just to differentiate between these two transactions, basically we are having the counterparty risk more in OTC segments, and this is exchange. Exchange doesn't have any counterparty or any credit risk, because this has to be a big failure of exchange, or a big failure. This would be like there has to be a big recession, uh, or any big credit event, so that the exchange would itself would not able to fulfill any of the obligations or any of the transactions. but still there is a possibility of exchange any due to any economic crisis or any financial event. There are still chances that exchange may also default, but those chances are very few compared to the OTC market. So again, moving on to the next topic. So since we are clear, the counterparty risk mostly arises on the OTC segments. We can just go through the financial products also. So repos and swaps are one of the classic examples where we can say that there is a counterparty risk. So repos are basically uh, say if I say there are two parties A and B, then A would be entering into a repo transaction by selling some securities, and B would be entering a reverse repo transaction by buying these securities and, in short, giving cash. So these are basically or repos are very short period or short transactions on the which are like transacted on the overnight basis only. So since these are highly liquid, we cannot just simply eliminate the counterparty risk in this products also. So while entering into the agreement, what the risk manager has to do is try to measure the financial health or try to measure the uh, try to understand what how the counterparties uh, ratings are, and accordingly he will ask for collaterals and he will ask to he will try to values those securities. Say if if I am a risk manager of if I am a dealer of bank A and I want to I have almost like 100 shares of say any company, say company XYZ, then which is currently uh, valued as almost say 1 million. So since I have this in terms of security, so this is not liquid. So what I would do, I would enter into a repo transaction. I would give this securities as a collateral to another bank B, and who in turn will give me a cash. But the risk manager of bank B would be applying in haircut. So haircut is basically they will be trying to mitigate the risk. So then, since this is an overnight transaction, so there are certain repos which are for 1 days also for different time period also. So there might be a chances that this 100 quantity shares of almost 1 million maybe overnight may turn to 50, then maybe valued as say zero point 0.5 million, or it may be completely devalued also. So whether to devalue, so how much it will be getting devalued or how much would be the current market value according to the risk manager will apply haircut. So as per the haircut, the since this is valued as 1 million, the bank would be giving me zero point 0.8 million only. So the haircut for this is zero point 0.2 million, or say in this case is 20%. So another way is other than haircut, what bank B can do is like say now this is since this is say repo of say almost uh, not of overnight, say it is for like 1 day. Then during the period of time, this 1 million values got devalued to say almost say 0.5 million. So what bank B would do? Bank B would be saying that since your value of your securities which you have given me as a collateral is almost diminished to almost is half its values, I want some more collateral to in order to ensure that the my transactions or my the contract is valid. So accordingly, he would be asking you again just to maintain this zero point 0.8 million value. He would be asking him almost additional collateral of zero point 0.3 million. So through such transactions, through collateral, through haircut, we can try to mitigate the counterparty risk. So as I gave you the example of the repos in this particular financial product, the repo product. So another way of try to mitigating the counterparty. Yeah, Sandy. Yes, please type in your question. Okay, so you want me to clarify the haircut? How this is not the haircut. The zero point 0.3 million is not the haircut. This is the additional amount over the period of time. No, this is just an absolute example. This cannot be like the actual values cannot be a zero point 0.3 million also. So this is I have given you just a simple example saying that since the over the one period of time, the security value which was given as 1 million as a collateral was valued as zero point 0.8 million by the bank B. So over this period of time, the market value got zero point 0.5 million. Are you able to see my screen or? Yeah, so the haircut is decided at the time of the repo inception only. Just a second, let me check whether my screen is shared or not. Are you guys able to see my screen now? I think I got a pop-up in between. That's why. Yeah, now is it visible now? Okay. Okay, so coming back to the example and coming back to your question. So haircut is charged initially only. Then again moving on to the say after one day period of time and again till the repo is not settled. Now the 1 million uh, value of securities. Now on the another day is getting devalued up to 2.5 billion. So now bank B started worrying, what about the 1 million stocks which I have received from the bank A. So the applicable, he has already applied an haircut of almost zero point 0.2 million. So he is not satisfied. See, say that I have not correctly valued the 1 million securities, and the applicable haircut is also not valid also, because over the period of time he had valued the 1 million stocks or the 1 million securities as zero point 0.8 million with the applicable haircut, and then the very next day that 1 million value got devalued to zero point 0.5 million. So he is still, so he has a very big risk, right? The risk manager or the dealer of the B is still is having a big risk, because suddenly the over the period of time, it there's the stocks which he is having got devalued to zero point 0.5 million, and he has paid zero point 0.8 million. So what he will do, he will ask for additional collateral. He will, so such agreements is initially decided when we are entering into the repos transactions, or when we are entering into the swap transactions. So this is the haircut is initially decided at the inception, and how much collateral to be posted also is also decided. So there we will be, I think we will be covering this topic ahead also. So how to value such transactions, and how much collateral to ask from the other counterparty risk, then how much haircut to be, how the haircut is determined, then apart from haircut, how the risk manager of each bank A and B, how they can try to mitigate the counterparty risk. Okay, so the example is clear, right? Now can we move ahead, or if you still have some doubt, then okay. So So every risk manager of bank A, every risk manager of Citibank or Barclays Bank will try to reduce its counterparty risk. So right, right. They can, that depends upon the agreements which they have, the agreement terms which they have entered while entering into the repos, or when entering into the credit default swaps or any other swap. So it is decided initially also. So for asking for collateral, the product has to be valued each and every time. So that's how we can ask for the collateral also, and that's how you can ask for the haircut also. So we will be covering this part again in the detail also, how to calculate such uh, haircut and the collateral values also. So right now, so one more technique to reduce the counterparty risk is through netting. So what is the netting? Netting is basically is trying to net the value of the transactions. So if I say, if I'm entering into a swap transactions with, say, there is an party A and there is an party B. Okay, let me check whether the example is mentioned here. Okay, so there is a netting example also. I will just I think it is there in further slides. So once we get into that slide, I will try to explain what exactly happens in netting with that example. So right now, just understand as like, so through collateral, through haircuts, through netting, we can try to reduce the counterparty risk. Again, another way of reducing the counterparty risk is trying to trade on the exchange traded products also. Since the OTC markets are, they are more prone to the credit risk. So again, once the credit counterparty risk is measured, then the risk manager tries to reduce, will try to reduce the counterparty risk. So as we know, any type of risk cannot be mitigated, but it can be just try to, we can hedge the risk. We cannot completely eliminate the risk. So again, to in order to hedge the counterparty risk, we have lot of credit derivatives. So we have another topic of types of credit derivatives only. So one of the examples is the credit default swap. It is one of the basic financial product used to hedge your credit risk or counterparty risk. So as I said previously, since exchange trading on exchange will also eliminate your counterparty risk, but it will definitely not eliminate your counterparty risk, because there might be a scenario, or there might be a systemic crisis, or there might be an economic crisis, a big financial crisis, in which may lead to big exchanges also, which are assumed that they will never fail. Prior to 2007 crisis, it was assumed like big banks and regulators almost assume the big banks are almost financially stable. The exchanges, which is regulated by the all the banks, big banks, are also where there is very or almost zero probability that such banks would be failed. But after the 2007 crisis, this completely changed the scenario, and now we are we are studying about the exchanges also, how a big exchange can fail also, and how that can lead to a systemic crisis also, because of failure of one single exchange can impact the lakhs of the counterparties, or the lakhs of transactions who are trading on the exchanges. So this, which can lead to the failures of banks also, which can lead to the failures and many economic problems in the country. So the central clearing parties which are available, which are there in the exchanges, there is, I think there is a separate case study in the current financial topics, where we are, there are almost two case studies, that how can the central clearing party can fail, and how that can lead to the systematic crisis also. So for time being, just remember the counterparty risk can be mitigated by trading on exchanges as compared to relatively to the OTC markets. Okay, so since we have covered a little bit theory on the counterparty list, let us try to solve one problem. So just go through the question and type in your answer. Then after 1 minute or 2 minutes of time, we will try to look into each and every option and try to understand each and every. Okay, so we have got the answer. Let us go through the question and try to understand each and every option. So the question is, bank A is a repo seller and who borrows a cash. So similar to the our previous example, and counter B is a repo buyer who lends cash. So basically, bank A is giving you the securities. So he's let me type here. Bank A is selling his securities, and in turn he will be receiving cash, and bank B would be lending a cash, so he will be buying the security and he will pay cash. Okay, so now let us check which is the true statement and which is the correct statement, sorry, which is the false statement. So a higher haircut reduces or mitigates the counterparty risk faced by the lender counterparty B. So this is true, but this cannot be a part. Even through over collateralization also, it will not completely help you to mitigate your counterparty risk, but it will definitely, it will in turn try to, it will increase your price of your repos only. So over collateralization means you are trying to ask for more securities, and in turn you will be paying very less cash. So in the previous example of 1 million securities, I was paying almost zero point 0.8 million, right? I was paying, party B was paying zero point 0.8 million, and the securities was valued as 1 million. So after applying haircut, my counterparty B has agreed to pay him cash of almost zero point 0.8 million. But now, due to what would happen if I apply a higher haircut, so what I would do, I will tell him like, I'm not sure, I'm not very confident on your 1 million stocks. I will be applying a higher haircut and I will give you say a zero point 0.6 million only. So this is more haircut. More haircut means I'm uh, trying to reduce my risk, and I'm uh, trying to pay him less. So what would happen, because of, instead of paying zero point 0.8 million, if I'm paying him zero point 0.6 million, so I am almost covering my loss of zero point 0.4 million. So what would happen, say tomorrow when this repo is going to get settled, or say if the counterparty A is not willing to fulfill its obligation, I have 1 million stocks as in collateral, which when I sell it to currently in market, I would say receive say almost 1 million only. But since I have paid him with the applicable haircut of zero point 0.6 million, I would be getting profit of almost zero point 0.4 million. Correct? So this is true. But what would happen? See, there would be very few banks who would be who would agree to enter into such repos. There would nobody would be agreeing to uh, devalue his 1 million of securities to almost zero point 0.6. So there would be very uh, few parties, but even though there would be a few parties, but still this option is correct. The more I apply the haircut, the more would be my chances of reducing my counterparty risk. So my option A is correct. So the question is, I need to find which is false, which is incorrect. So option A is correct. So let us go to directly to third option. The repo seller bank A borrows cash and therefore will not incur counterparty risk, or counterparty B can incur counterparty risk. So this is also true. So now this is, since why this is true is, since A is receiving cash, it will be not this is he will be not into more into a positive exposure. So even say now A is A B, why B is having a counterparty risk is, say now since he has given the cash and he in turns has the securities also. Now for any, due to any occurrence of credit event, the counterparty A is not able to fulfill its obligation. So okay, so just to give you an initial, what to say, initial background of repos is, this is an initial state of the repo in which the counterparty A is selling the securities and B is buying the securities. The counterparty A is receiving the cash and B is willing to pay the cash. So, so this is the initial transaction. Then after an overnight or the given time period, what would be happen? The counterparty B would be buying back his what to say? Sorry, the counterparty A would be buying back his securities, and uh, and in turn he would be paying party B some cash. So now this is how the actual repos work. So now they have entered into 1 million of say repo. Then after repurchasing the repos, say if he buys it in almost like zero point 0.7 or zero point 0.8 million, so party B would be having a profit of 0.2 million. So this is the part of the settlement actually. So now how the counterparty B is having the counterparty risk and why not the counterparty A? Say now since in the initial part of the transaction, party B has paid the cash and he has the securities only. He has the securities in his depository or whatever, uh, uh, whatever the mode of the transaction is. So due to any credit event or due to any crisis or due to anything, uh, due to any financial condition of party A is not willing to repurchase the securities and he is not willing to fulfill his obligation. So what the party B will do? B will try to sell the securities into the market. So when he is trying to sell the securities in the market, nobody is ready to buy the securities because there is certain financial crisis and this securities of XYZ is, say this is securities of Barclays Bank or any Lehman Brothers or any institution. So there was a news saying that the Barclays Bank has gone bankrupt and nobody is willing to buy the securities of Barclays Bank. So overnight, the stocks of almost 1 million Barclays Bank got devalued to almost zero, or it become illiquid. So nobody is ready to buy this securities. Now, since party B is already entered into the repo transaction and he already has the securities, so what he is not able to sell just 1 million securities into market also, and neither the party A is willing to fulfill his obligation or trying to repurchase the 1 million stocks. So this is the risk which the party B is taking. That's why he is facing the counterparty risk and not A. That's why in order to mitigate the counterparty risk the which the B is facing, he is applying the haircut of almost 0.2. He will ask for collateral. He will try to net the agreement. Okay. So now This is correct. The option C is correct. Let us move to the next option, which is the fourth option. The repo buyer counter B is exposed at the minimum credit risk. Let me scroll actually. Okay, the repo buyer counterparty B is exposed at the minimum to the credit risk default by bank A, the market risk, the liquidity risk, the operational risk, and the legal risk. Okay, so before this option, let us go to the second option also. The securities sold by bank A become collaterally legally owned by counterparty B, who is in the event of bank A defaults and can liquidate the collateral in order to recover the cash. So why this is incorrect is this because this is a repo transaction. So even though the this party A is selling security to party B, this cannot be the collateral cannot be legally owned by the collateral B. So this is basically the in terms of legal terminology. Party B is is having a lien marked on party C. So this cannot be true. That's why this this can be a false statement also. They cannot legally own the securities, but instead they can just the collateral is a type of a lien also. It cannot be you cannot transfer the securities in the name. It will be still in the name of counterparty A, but this cannot be legally transferred to counterparty B. Okay, so okay, Sandy, I didn't get your question. So in case of a default, can you type in your doubt? Okay, so meanwhile, just let us go to the fourth option also. The repo buyer counterparty B is exposed at the minimum credit risk. That is right. Market risk which is arising due to change in price of this 1 million security because of the price volatility or any change in interest rate or due to any news also the value of this price the almost 1 million collateral would keep on changing. That's why we will be having a market risk also. Again, same liquidity risk. If there is a total crisis, then nobody would be willing to buy this 1 million securities. Then we will be facing the liquidity issue. Again, similarly, the operational and the legal risk also. So the correct answer for this is it is B. The false is B and C also. So let me get back to the. Okay, Sandy, let me complete this and I will just get back to you. I didn't get your question there. Let me tell you why the C is also incorrect. So I told you the scenario how the counterparty B is facing the risk as compared to counterparty A. So now let us take the another scenario where the counterparty B is not willing to fulfill his obligation. Again, the same transaction, counterparty A and B has entered into the transactions. Counter B is selling the securities of almost 1 million, and counterparty B is paying you almost 0.8 million. Now, since this is the repo transaction, it has to be settled. Now, at the time of settlement, the counterparty A wants to buy back his securities. Since this is an overnight lending, so for the overnight, he has got almost cash of 0.8 million. Now, tomorrow morning, the counterparty A or the bank A wants to get back his securities. So what he will do, he would be buying back the 1 million security. But say what the bank B has done. Bank B has uh, taken this 1 million securities, and he has given this securities or transferred this securities through lien or through any other transaction to other counterparty C. So what he is doing, he is not ready to fulfill his obligation, and he is not ready to give back the 1 million security deposit or the collateral which he has taken from counterparty A. So again, in such scenarios, A would be bank A would be not getting back his securities, and then they would be not, this transaction would not be settled, and that there is a risk for counterparty A also. So basically, we cannot say the counterparty risk for both A and B is one way. It cannot be unilateral. Both A is facing risk with respect to B, and B is also facing risk with respect to A. If any of the banks or any of the counterparties are not fulfilling the obligation, this this can lead to the risk by both the parties, and both of the parties is facing the counterparty risk. It cannot be only counterparty B is facing the risk, or only counterparty A is facing the risk. Both of them are facing the risk. So the correct answer for this question is B and C. B is incorrect because this cannot be legally transferred. This is kind of an, what you say, legal terminology. This is, the collateral can be marked as lien also, but the ownership cannot be transferred to the other party. The collateral, the clauses which are mentioned in the collateral is this can be transferred for a particular period of time only, but this cannot be uh, cannot be what you say, cannot be named into the other parties. Okay, right. So that yes, this is the correct question actually. So how they will be able to sell? They, this this is the part of the repo agreement only. Uh, this will be applicable in terms when any of the counterparty is defaulting. So B can be able to sell the in the market when A is defaulting, or A get bankrupts, or any other event is occurred. So this is entered in the agreement. So in case if say A is not defaulting, so that cannot be case. B would be going. B can take this completely own this securities and trade into this 1 million securities. So this is possible in only in case of default only. Okay, so is it clear, or so Sandy, you had a doubt. So what exactly your doubt is? Right, right. So sorry. So this is then correct. This statement is correct. I did not read this part actually. This in case of bank default. So this is correct. This was the clause I was looking for. So I had read almost since this legally owned only. So this option is correct also. So the only incorrect answer is is C. Yeah, can you come again? What exactly your doubt is? In an event of a default, how would be the bank B would be recovering his amount, right? Is this your doubt? Just I will just unmute you. I think it is taking time for you to type in the chat. Let me just unmute you. Yeah, Sandy, you can speak now.
Hello.
Yeah, Sandy. Yeah,
Yep.
please tell
My
me your doubt.
question is, yeah. Let's say the option C that we have, the repo seller A borrows the cash, right? So which means how A can incur the counterparty risk? Why? Because A has borrowed the cash
Right. So
from B.
as I said, so
Uh,
there can be any scenario where B would not be wanting to fulfill his obligation.
right.
So this
Agreed.
repose
Agreed.
needs to be settled, right? So this for the settlement of this repose, he needs to give back the securities, and A needs to buy back the collateral or the securities which he has lended to bank B. So this needs to be reversed. The initial transaction which the repos they have taken, the transaction which they have done in the initial repo, this needs to be reversed by settling the repo. So for while at the time of settlement, the bank B doesn't want to give back the securities. So for any reason he will, for any reason or I don't know, for any specific there. So there is a risk the
No,
bank
I
B
have a
would
point
not
here.
be.
Maybe let me complete my question so that you can able to answer. So let's say in this scenario, physically, still A is the legal owner for the securities that are being pledged to B, right? So which
Right.
means A never be at counterparty risk. B only be at the counterparty risk taker. The reason why, B has transferred the funds to A, and A is still legally a owner of the securities that are being pledged to the B,
Right.
right? So in that case, C is also correct, right? It's not the answer for this question. The statement C is correct. Only counterparty B can have the counterparty risk. The reason why, I'm basically from the valuations team. I know while calculating the CVA and all, it's a one-sided, and A will have DVA, debit value adjustments, that we will be posting.
So see the essence of this question was to make you understand. So this is basically the what you say. This question is kind of derived from my experience only. So
Hmm.
so the point why I had included this option was I wanted to tell you the counterparty risk cannot be a unilateral or one way. So it can be both ways. So there are chances for any reason that the counterparty B is not fulfilling its obligation. then A will also will face the risk. So
Yeah,
that's why
great.
this.
In kind of swaps and all, definitely both the counterparties might be at the race. So in that case, we can say both the sides we can have. But as a repo, where A is still the legal owner of the collaterals that are being pledged to B, and A has the cash currently it is holding.
Right.
In case A is not able to fulfill the obligation at the time of the expiry of the repo, then B would be in a a counterparty risk.
So what if due to any say legal loophole, B
Mm.
B has liquidated the securities before the settlement. B, this 1 million securities, B has taken those securities and sold it in the market for
That's
it
what.
due to any legal loophole. So there is a
But
risk, right?
legally, B can't be a owner, right? In case of repos.
So that's okay. So let us not get into the what you say more
Uh,
legal terms or
yeah,
the
yeah.
essence of this.
The
Yeah.
reason why for securities that can be bond and bonds, example. So let's say A has pledged the bonds to B, but still A will receive the coupon payments. B will not be receiving the coupon payments, which means A
Right.
is a legal owner for the securities that are being pledged.
Right.
So
So
let me add to some points here. We can use that securities and trade in market with another counterparty, third counterparty, which maybe get default and the security that B is not able to fulfill the A's obligation, right? That we can consider that case as well. We
No,
can do
at
that.
the kind.
Mhm.
No. Only when A will not able to fulfill at the time of expiry. Until then, B can't be a owner for the securities. B can't trade them in the market. So A has pledged the collateral, which means still A is
so
the legal owner.
Sandy, we are just telling you to just consider a scenario
Okay.
on theoretical purpose, saying that the B is selling or liquidating the securities, due to which there will be he would be not be willing to fulfill his obligation. That's why there can be such scenarios where A might be facing the risk, counterparty. So see, you will encounter such questions in the FRM part 2 because there will be very close options where it will be like debatable, like whether this is correct or the another option is correct. So,
Agreed.
so the essence of this question is just to give you a feel like how you will get the questions in the exams also. Because the initial questions which I had given you from the Swagers, so those are just kind of an basic questions only. So this you can expect such what you say such debatable questions or such complexity questions in the exam.
Okay. Okay.
Okay. So we do at as such at least we are clear with the concept, right? So we are not going to have the same question in the exam, but at least the if we are clear with the concept of the counterparty risk, then we can handle the other complex questions which are coming in the exams also.
Yep.
Okay.
Yep.
So let us move on to the next topic. I will just mute you all in order to avoid any background noise. Okay. Okay. So let us move on to the next question. Right. So these are some of the terminologies which I had covered in the very first slide also. So now, if we are if we want to measure the counterparty risk, then it is again similar to the credit risk. Sorry. So it is again similar to the credit risk, and if we are measuring the credit risk, we need to know the three terms. for simple quantifying it, it has to be exposure, then it has to be a probability of default. Then again, if it is an exposure, then what would be the exposure at default? Then again, what would be the loss given default? So just the simple quantifying terms to understand, to measure, to quantify the counterparty risk. So in order to first to calculate the exposure for any counterparty or any transactions, so it has to be, it is not as simple or simply as I told you the example of loan. Yes, given the Citibank has given an 100 million loan to bank B, so we cannot directly say the 100 million loan is the exposure at the given point of time. So in order to measure the exposure, we need to know the time also. So at what point of time, or at the current or at the present value, or in the future, what would be the exposure? Then at the current state of the transaction, what is the current exposure? So these are the questions which we need to answer in order to measure the exposures of the, with respect to the counterparty. So we have several terms again in exposures to measure. So this we will be again covering in the separate topic altogether for measuring the exposures, as the potential future exposure, and what is the EP, what is the expected positive exposure. So for the time being, just let us understand the simple basic definition of exposure, uh, which exposures is can be defined as current, at the current point of time, or at the future point of time. What is the actual, uh, what to say, the amount, or the amount which is at risk, if the counterparty or the other party is default. So you can, if you want, you can just go through these slides. Okay, let us directly move to the, again, same, the another terminology is the credit exposure. So credit exposure is just same, uh, an extension of the exposure, but the another clause which is added is, it is in the case of default only. Okay, so the next topic is the credit migration. So in case of uh, the credit migration is basically, so whenever you are trying to assess the credit quality of any, the counterparty, say if it is a retail bank, what you will do is, for any retail customer, you will try to check his financial health, how good he is to his ability to repay his loan. Similarly, you would be doing it for the big financial institution also. But for big financial institution, there are credit rating institution which measures the credit quality, or say the financial health of the whole institute as an institution. So over the period of time, say due to any economic crisis, or due to any operational risk event, or any of these scenarios, there might be uh, a devaluing or a degrading of its credit quality or its credit rating also. Say say S&P or Moody's rating has valued today as any Axis Bank, or has, they will, in order to value them, uh, they will give them the credit rating. So if they have today, they have given them, say for example, a triple A rating, then due to any scenarios of any economic crisis or any news in Axis Bank, the again Moody or S&P would be tried will re-evaluate its financial health and say they will downgrade its rating to say B or triple B. So such event would be classified as credit migration. So this is just one of the terminologies you need to know in the counterparty risk topic. Again, similarly, as I had explained you in the very first slide, the probability of default. Okay, let me try to give you an example for this. Okay, so I don't have any example. Okay, let me just try to explain you in this theory only. So the counterparty defaulting and the credit migration or the future default probability. So how can we distinguish in this between these two terms? So if I say the probability of counterparty defaulting in a certain time period can be defined as the future default probability. But again, what is the probability of a counterparty suffering a decline in the credit rating or the credit quality or a credit downgrading? We can say such event into the credit migration. So, what I'm trying to explain you is like, say in exam, if you are having an question, again it will be an ambiguous question because you must be knowing how the complexity and the toughness the toughness of the question which appears in the exam. So just to give you an question is like how how you are going to distinguish between the future default probability and a credit migration event. So in a credit migration event, if anything is related to the credit quality or credit downgrading, then we can classify such events into credit migration. Or but same, this is in the credit migration also. We also measure the probability of the counterparty, but in terms of degrading or downgrading of the credit quality. And this future default probability is simple kind of a definition of like in future how what is the probability or what is the likelihood or what are the chances of the counterparty defaulting. So this is clear, right? Or do you want me to give you an example or a question on this? Okay, so again, so the other terminologies are mark to market, replacement cost, asymmetric exposure, and future potential. So the more classification of exposure we would be covering in the forthcoming, actually, it is altogether in different topic only. Mark to market is basically the current value which we are measuring on day-to-day basis. So if I say how do if I'm like entering into a sharp transaction, so I would be trying to value it on the daily basis. So if I'm doing a daily mark to market, so what would happen is like for each and every day I would be getting its current value, and for in through mark to market I will be able to reduce the risk of the valuation also. So these topics we will be again covering separately in the exposure also. So, okay, so for the future default probability, I think I might be having some questions for this particular topic in the further slides. Okay, okay, let us do this example. This would be more helpful actually. So just go through the each and every option and type in your answers. Then we will go for each and every options and try to eliminate. Okay, we got an answer from Bhupesh. Okay, let us wait for Sandy for another minute. Okay, so we have got the answers. Okay, let us look into each and every options. So counterparty risk exclude pre-settlement and the settlement risk. So this is definitely false. As I said, this as I given you the example in the previous repos example also. So this, if any of the counterparty is not willing to settle or is not willing to fulfill its obligation, this might lead to the settlement risk. So definitely the settlement risk is included in the counterparty risk. So the option A is false. This because this does not exclude, this includes the pre-settlement and the settlement risk. Then the option B, in contrast to counterparty risk, settlement risk is characterized by small exposures for long period of time. So this is also definitely not true. So we cannot say anything about the exposure in the long period of time. So this needs more information. What is the actual transaction? What is the actual financial products? So this we can eliminate. Now let us move on to option D. In the credit derivatives market, notional outstanding is one of the most one of the more accurate measures of the counterparty risk in the system. So again, as I said, the notional outstanding or the principal amount is not the easy way to quantify the exposures. That's why, in order to measure the counterparty risk, we are measuring the CVA, in order to measure even the credit risk also we use CVAR, but we do not use a simple quantifying any values such as notional outstanding also. So definitely D is incorrect. So we have already eliminated A, B, and D. Let us check the last option, C. The counterparty risk mitigation does not eliminate risk, but instead converts counterparty risk into other type of financial risk. So this goes with our basic definition of risk only. So we give the basic definition or the basic characteristics of any risk is we cannot completely eliminate the risk, because we can try to mitigate or we can transfer it into any form of other risk. So among the given four options, the answer should be C. So this is the most true as compared to the other options. Again, for the option B and option say for particularly for option B, we would be requiring more information. But since we are doing an elimination kind of an answering system, so we can give the we can say the correct answer is C. So Rupesh, you are clear with why option A is incorrect, right? Or do you want me to explain it again? Yeah, Rupesh, I'm waiting for your answer. Okay. Okay, let us move on to otherwise. Let us move on to the next slide. Okay, just type in your answer in the chat actually. I think I have muted you. Okay, let us move on to the next slide now. So the next slide is so most of these terms we have already covered how to mitigate your counterparty risk. So again, to mitigate your counterparty risk, you can obviously you need to trade with the counterparties whose financial health or which are which are having good credit quality, or they are after doing the full inspection of the counterparty, you need to enter into agreement or enter into transactions or trade with such institutions on. So this is very simple. Again, diversification can you can through multiple geographies also you can try to eliminate your risk. If you are concentrating each and every transaction into say your European area, you can again diversify into other North American or any other geographical areas. So that is a part of diversification. Netting, netting is again okay. Netting is basically to just to offset your positive exposure. So again, this I will cover in the coming slide in the with an example. So in that slide, it would be very helpful to understand. Again, through collateralization. So if you are having more exposures uh, to any counterparty, try to ask for more collateral. You can hedge through any of the credit derivatives such as credit default swaps. Then again, this point is repeated. Trading with high quality counterparties. Okay, so let us go into details of netting. What exactly the netting is. So this is the example of netting. Now, so this is a swap transaction or any transaction, say it can be any loan transactions also, or repo transactions also, or any cross currency swap transactions also. So now what we are doing is, assume in this given example, this say institution is party A and the counterparty is party B. So what we are doing, let me use an highlighter. So say this is A and this is B. So what we are doing, we are trying to measure our exposure on day-to-day basis. So we are trying to measure our exposure and say party A is trying to measure his exposure with respect to party B. So now if this is for any given transaction, he is having a positive exposure of 10 million. So obviously, say this is positive 10 million, is he is going to receive some 10 million money from in any of the swap or any of the repo transaction or from the counterparty B. So that's why he is in positive 10 million. And since the party B has to pay 10 million to party A, this is negative 10 million. So this is, say for example, a repo or a, say for a swap also. This is the current exposure. Now, in another swap transactions, there is there will be say a multiple transactions or multiple products which party A is having with party B. So whenever a party A is calculating his exposure, he would be taking for each and every financial product. Say for another, say in another transaction, he is having a negative exposure. So in this case, he has to pay 9 million to counterparty B, and counterparty B has to receive 9 million from counterparty A. That's why this is positive and this is negative. So what would be what and the risk manager or what a dealer would do? He would be netting this. He would be netting the both the transaction. Because in short, when this has to be settled or this has to be exchanged, so there is no need for counterparty A to pay the whole 10 million, then to receive 9 million, then for another transaction he has to pay 9 million and counterparty B to receive 9 million. What he would do, he would net this both the transaction of positive 10 and receive negative 9, and in short after the exposure after netting would be he has to receive 1 million. Okay, so this is for counterparty A. This is clear, right? The exposure for netting after netting. So this is what we called as netting. Now in case of the exposure, if I'm not netting is 10 million, because we don't consider the negative amount or the amount which we are going to pay to because say in case of default also, so I would be not be paying the negative because I have defaulted, I am counterparty A, I am not going to pay this 9, but my loss is of 10 million because currently I am going to receive the 10 million of the exposure. That's why the exposure without netting is 10 million, and with netting, I'm doing after I'm going to pay 10, I'm going to receive 9. That's why in short, instead of doing each and individual transaction separately, what I would do, I would net both the transaction and in short, I would be receiving positive 1. Again, let us now go to counterparty B. Again, counterparty B has to pay 10 million and he has to receive 9 million. So without netting, the exposure is 9 million, because again this is the payment of 10 million. So if I'm defaulting for or the any reason the party is defaulting, then I don't have to pay 10 million. So I'm not in loss for this. But if I'm not receiving this 9 million, I'm at loss. So my exposure without netting is 9 million. If I'm that's why, but with netting it is 0, because I will be not be receiving any money from the counterparty A. Please note that this netting has to be done between the same counterparty. If say there is one more counterparty C, which the party A is having transaction with say positive 5 million, so this netting of A and C would be separate. This cannot be netted with party B. This transaction is totally different. So whenever we are doing netting, we can do multilateral netting, but multilateral netting is altogether a different concept. So basically, when we are doing a netting, we are doing a netting among the both the parties, and we are trying to find out each and every transactions which we are having with the same counterparty B, and then we are netting and we are trying to determine our exposure. Okay, so we would take an example also. We will solve a problem on netting also, just to be more clear. Let us get back to the previous slide. I need to, yeah. So the example is clear, right? Okay, let us go to the definition. So, the definition says the netting agreement is a legally binding contract that allows the aggregation of transactions. Perfectly offsetting transaction may be netted against one another. Hence, they will always have a zero value. One will always have one will always have the negative value of the other. So this is basically the one. If say the exposure of the party A is received 10 million, then of course the exposure of the party B would be to pay 10 million. So if one is having positive 10, then the other has to have negative 10. So again in netting we have cross product netting and without netting. So in this example, so as I told you, this is the first transaction with the positive 10 million exposure, and the second transaction is with the negative 9 million exposure. Say if I'm doing a cross product netting, so the financial product for first transaction is a swap, and the say for the second it is some cross currency swap. So I can swap this, I can net this two products, but I cannot completely say I will take a loan or say any other, say any margin loan or any other different product and try to net it. So there are still certain products or certain transactions only which we can net against them. We cannot completely like differently net altogether different transactions. Say if this swap transactions, there is a transaction with a total different geography on this. Say this I am entering a swap with some European geography. Then if I'm entering a swap with say some another say Australia geography. So again, that depends totally upon how the risk manager wants to net it. So if he wants to net the transactions of swaps within the European area, then he cannot use the same transactions of the he has to use the same transactions of the same area, but he cannot use the same transactions of the different geographies. Again, if the definition of the cross product netting is I will use it to say if this is a cross currency swap of same of European region, then I would be netting this. So this is the basic like what happens in the cross product netting. Again, then without netting, basically without netting, I would be considering the positive exposure only. I would be not be considering the negative exposure where I have to pay it a certain amount to a different uh, or a different counterparty. So again, without netting, the derivatives will be having a negative value which will be settled. But see, as I said, this negative value I would be not be considering because those exposure doesn't affect me. Only the positive exposure is going to affect me. That's why while netting also we and without netting also we consider the exposure with the positive amounts. Okay, so this was the example which I had explained you. Okay, let us take one example. Then again we will take an example of netting also. So just go through this question and type in your answers. Okay, let us wait for Rupesh to give an answer. Okay, let us go through the question. So, Online Financial uses a variety of techniques to manage the counterparty risk. It has entered into interest rate swap with score, say party B. Currently, Online position, say party A position is in the swap as negative 1 million mark to market value based on the information provided. Which of the following credit risk mitigation techniques would be advantageous to the Online? If uh, if party B defaults. So this is simple. Say online is party A, then Scorbo is party B. Now online is having a negative one exposure. Then obviously party B he negative one means he has to pay 1 million to party B. So obviously party B will be positive one. Party B will be receiving 1 million uh, of transaction or 1 million rupees or any currency from party A. So, what is the correct credit risk mitigation technique? So, okay, so closeout. I think I have not explained you what the closeout is. So, closeout is basically one of the another the credit risk mitigation, now the counterparty risk mitigation technique. Closeout is basically you can close out the ISDA agreement whenever you are entering into the swaps. Like you can for any or whenever the certain conditions which are mentioned in the agreement arises, what we can do, both the party mutually agrees to close out the transactions. So this is what happens in a closeout. Collateralization, as I have told you, so if in order to value and constantly value the a transaction in if more certain party is getting more into negative exposures, or it is going to receive more money from any counterparty A, and he thinks that that counterparty is not will be able to fulfill or pay him back, so he will be asking him the collateral. So this was the another technique, through collateralization. Netting is just as we discussed, and D is walk away. Walk away is one of the features in the agreement, in which what you can do is say if any of the party defaults, then you would not uh, there would be clauses like if certain conditions are not met, then the agreement is not valid, and we would any particular counterparty would be walking away from that agreement. So since he is having certain exposure with counterparty B, so the correct result would be the correct option would be netting. Okay, go through this question also. I will just tell you what is the potential future exposure and the current exposure also. I think we did discuss about this, right? The current exposure and the potential. Current exposure would be the exposure at a given point of time, and the potential exposure would be for in the future period. What could be my exposure with the another counterparty in that particular transaction? Okay, do you want more time, or well, let us go through each and every option? Yeah, yeah, yes. For B and C, we will go individually. Okay, so let us go through the question. Each of the following is necessarily true about credit exposure, current exposure, and the potential future exposure. So which we need to find which one is false. So credit exposure is conditional on counterparty default. So this is correct. So this is the basic definition of the credit exposure only. Now let us go to second option. If mark to market of contract is negative, then the current exposure is 0. So this is also correct actually. So as I said in the previous example also, in this case, this trade was having negative exposure, but with the with M2M. So the exposure for this transaction would be 0 only, because we would be not be considering the negative. So this is also correct. The current exposure is 0. If mark to market of the contract is negative, the credit exposure is 0. Okay, so C I will get back. Let us check D option. Credit exposure encompasses both current exposure and the future potential exposure also. So this is also correct. This is also a definition of the credit exposure only. So let us check why C is incorrect. So if the current mark to market value is negative, the credit exposure is 0. So why the credit exposure cannot be 0? Because the credit exposure contains both the current exposure and the potential future exposure also. So if the M2M of the contract is negative, so definitely the current exposure is 0, but we cannot say anything about the potential future exposure. So in the future, so this may turn to negative also, or this may turn to positive also. So that's why option C is incorrect. So the correct answer for this is C is false and the rest A, B and D are true. Okay, clear. Okay, let us move on to next. So again, this is a simple exposure for simple question for each and every financial product. So you just if you know the payoff of or the exposure diagram of each and every products, then you would be easily able to answer it. So just go through this and just type in your answer. Okay, Sandy, do you want more time or let us go? Okay, so we have got the answer. Okay, let us go through this question. In the trade with a counterparty, which of the following position offers the greatest potential future credit exposure? So this is more relevant to the exposure in the coming time or in the future period. So the key to solving this question is to look into this long and short position on. Then we can try to figure out whether it is a call or whether it is a credit default swap or whether it is a forward. Okay, just to first to clear out between long and short, which would be the positions which would be having the greatest credit exposure. Just type in long or short. Okay, so I will tell you why it is not short. Short is basically because you don't have in the short position. If you are say if you are a short forwarding or of 1 million, so maximum loss you would be incurring in the short position is 1 million. But you cannot have the what to say. There is no unlimited there in the long position we have unlimited upside, and in the short position we don't have what to say unlimited upside. That's why this is terms in terms of exposure. That's why the short we already know what we are having the exposure in the short positions. That's why it has to be long position. So we are eliminating option C and D. Then again it has to be long call or long put. Then again in long call and long put, since the payoff, if you remember the payoff of the in part one, we have done the payoff of call also. So it is, let me try to draw it. It's simple, right? It is, so this is a payoff for a long call. So we have the in the for future, this will be the future time, right? Let me erase it again. So this is my x-axis, this is my y-axis, this is my premium, and from here my exposure for this long call would be the value which this call is in the money. So this is having the unlimited time also. In the future also this would be this exposure would be, I don't know what would be the exactly exposure of this call, whether this would be going like this or whether this would be going in with less slope. So the question is, which of the following positions has the greatest potential credit exposure? So we don't know about this, the future position of this long call, because and this has the unlimited upside probability also. That's why the correct answer is long call. Is it clear? I think I have misplaced the chat box. Okay. Is it clear, or do you want me to again explain you why it is not in short position and why it is a long position? See, as I said, in short position, you cannot go below zero, right? So this, if I'm say this is, if I'm taking a short call, okay, this will go on, keep on going on negative, but the negative exposure will bit to M2M will not be affecting us because I have to pay this. I need to pay the value of this, but I'm this cannot go beyond zero. The exposure for the short position cannot go beyond zero. That's why the the chances of this for the credit exposure, maximum credit exposure is long call. Okay, so let us now move on to next question. If you have doubts, you just ping me in the chat. I will pause for it and again I will go back to the question. Okay, so just in simple, this is a simple question. I think this should not take much time. Okay, so you want me to go back to the short position again? Okay, let me figure out any number. See, the best example is for the short position is in the previous slide only this only. So if I'm into a short position, I have to pay it. With this counterparty B has to pay. So that's why he is in negative. And the exposures for this with netting also and without netting also, we do not take the negative amounts. Okay, let us move on. I think for actually I think we are running short of time. I think we have to cover one netting example also. Yes, the loss can be maximum, but we are talking in terms of exposure. So what if you are already shorting a particular instrument, you are already determining that amount. Your your exposure. It is not about profit and loss. It is about the value which you are, which or the current amount which or the exposure which you are having. Okay, so then let us move on to next example. Let us take the, I think Okay, so this was a little bit relatively easy question. So I think let us not go into detail of this. An exchange traded derivative is obviously uh, the one with uh, less counterparty risk. Okay, so the closeout, I think the other types of the counterparty risk mitigation techniques is, as I told you in the previous example also, in the previous question. So, basically the closeout allows you to, when both the parties try to agrees with each other, and they would simply just close out the agreement. So this is again, as I said, one of the credit mitigation technique. So it happens mostly in case of bankruptcy. So again, just to read out this definition is closeout permits the immediate termination of all the contracts between an institution and the defaulted counterparty with the netting of M2M values. So combined with netting, the so-called closeout netting allows an institution to offset the amount it owes the counterparty against the amount it is owed to arrive at a net payment. So whatever the current at the time of default, whatever the current exposure is there, and so whatever the netted amount is there, so the closeout will allow you to exchange those amounts. So in this case, one of the counterparty is defaulted, and both the counterparty agrees to close out the agreement. So these are the features you can close out netting, collateral. These are the techniques which whenever you enter into the agreement, these are the features which needs to be considered in order to mitigate the counterparty risk. Again, same collateralization. So as I defined, so let me give you an example like for that same example with party A and party B. Again, this is having positive 10, and this is having negative 10. So in this case, the party A is in positive exposure. So he would be asking the collateral. So party B has to give collateral to party A. Say after one period of time, this exposure gets changed. Now he is negative, party A is negative, and party B is positive. Then the one who is having positive exposure, this, because if say party A is having positive exposure of 10 million, and B is not ready to pay him 10 million, he defaults, or for any reasons he is not willing to pay back 10 million, then A is at risk. So that's why in order to mitigate his 10 million exposure of risk, he wants collateral. So he would, the party which is who is the one who is having positive exposure would be asking collateral from the other party, right? So again, just to read out the basic definition. So collateralization provides a means to reduce the credit exposure beyond the benefit achieved with netting. So this is an additional technique to reduce your counterparty risk over and above netting. a netted exposure can still be large and positive. Therefore, there is a strong risk if the counterparty risk is to default. Same stuff if they say if even after netting, this is almost 100 million of exposure. This is still a big amount which has to be big amount which needs to be mitigated. The risk on such big amount needs to be mitigated. So we can mitigate through asking collateral from counterparty B. Again, the walkaway feature. Walkaway feature is in transactions where one of the institution is not agreeing and he wants to cancel the agreement. So they would try to net, and whatever their current exposure is there, they will try to net at that particular point, and one of the counterparty will try to walk away from that agreement. So just to read out its definition is, this clause effectively allows an institution to cancel the transaction in the event their counterparty defaults. So one of the clauses is one of the counterparty has to default. They would obviously only choose to do in their case the overall M2M was negative. Otherwise they would have a recovery claim. Obviously the one who has to receive the payment from the other counterparty will execute this walkaway feature. Okay, exchange and central clearinghouse we have already discussed. So let us go to the next slide. Okay, so this is a good example of netting. Just go through this question and type in your answer. Okay, so let us go through this example. So bank A has multiple positions, transactions in various bilateral contracts with party XYZ. Between them, they do have a legal netting agreement. Okay. From bank's perspective, the sum of the transaction with positive values, the bank XYZ owes money to bank on mark-to-mark basis is 7 million. So A has to receive 7 million. That's why A is 7 million. Positive 7 million. The sum of those with negative values, which XYZ is owed money by bank B on mark to mark basis, is negative 5 million. So from XYZ has to receive money from A. So this is negative 5. Now, so this we are mentioning with respect to bank A exposure. Now compared to the bank exposure, without netting, what is the reduction in exposure due to netting and the exposure gain due to netting? So to solve this question, we need to find what is exposure with netting and what is exposure without netting. So with netting, the exposure is 7 million. So why it is 7 million is because we would be considering the positive, the amount which we are going to receive. We are not worried about the amount which we are going to pay, because the amount which we are going to receive, if we don't get, if we not receive that, if our so that is our loss and that is our exposure. So if we have to pay negative 5, I am the bank A. If I have to pay negative 5, negative 5 million, sorry, I have to pay 5 million to XYZ, but XYZ himself is defaulting. So why would I pay him 5 million? I would first ask him to give him my 7 million. I would not be worried about him paying about me paying him 5 million. So that's why in order to calculate my risk, I would be calculating my exposure as 7 million. So with netting, my exposure would be 7 million. Right? Correct? So now without netting, my exposure would be 2 million. So again, without netting is basically I have to receive 7 million, but I also have to pay 5 million also. Oh, sorry, I have done reverse actually. So this is I have written with netting. With netting it is 5 million, and without netting it is 7 million. Sorry. So basically netting, in netting, what I would be doing, I would be calculating how much loss I am incurring. So with netting, I am with 2 million, and without netting, I am 7 million. So the difference is 5 million. So the exposure gain which I am achieving is 5 million. Okay. So this is clear, right? Right. So netting means we have to take the net amount which we with our positive exposure and with our negative exposure, we have to take the net amount, which in short, which we are going to get or receive from the counterparty. So this is the similar example, the one which I had shown you in the previous slide, the same one. So this is positive 7 and this is negative 5. So my exposure with netting is 7 minus 5. Actually, this is negative 5. This should not be written here. It should be coming below here. This is exposure with respect to XYZ. If I am writing negative 5 is means so that would be different meaning. If I am writing negative 5 from, then it would mean the XYZ has to pay me back in case of default. But now, so if I write it here, it would be more clear actually. Okay, so let us move on to next slide. So this is the last topic. Let me check if I'm able to cover this in 15 minutes. Okay, so this doesn't has much of an importance from the point of view of exam actually. So as I said, exchange can there are exchanges which are defaulted. Uh, there are institutions which are rated AAA, which are also have been defaulted. So such type of big institutions are termed as too big to fail counterparties. So before 2007 crisis, everybody was of view big exchanges and such big banks would never fail. And now, after the 2007, they have introduced this cases where we are trying to evaluate the big institution and to check out how there can be a counterparty risk because we initially thought such big institution cannot have counterparty risk on it. They do not have credit risk on it. They would be always be fulfilling their risk. But now, after the 2000 crisis, any big institution, any big country, or any particular individual counterparty, there is always a risk, even though it is 0.01 or any amount, but there will be definitely be a counterparty risk. So this is just because we heavily relied on such big institution and we thought they would be never be failing. So this because of such thinking that had led to big systemic crisis across different geographies also. So let us just jump on to the last topic. Basically, so this topic is just an introduction of what is CVA. So CVA calculation and CVA in details would be covered in altogether a separate topic also. So let us uh, let us just go through a simple what is CVA and why we are currently looking into CVA. So CVA is basically a measure to risk of major counterparty risk. So CVA is credit value adjustment. So in order to hedge your counterparty risk, I need to first measure my CVA. So after measuring my CVA, once my CVA is calculated, so what I would do, I would try to introduce that value into my pricing of the particular, say, swap or particular transactions which I am entering into my counterparty. So again, this can be basically, if I want to say the definition, uh, it can be said as the risk-free transaction. What if there is no counterparty risk? Then what would be my actual price of that transaction? So through such, if there is no risk, then what would be the value which I would be considering of that particular transaction? So that particular value is measured through credit value adjustment. So by definition, the risky price of derivative can be thought of as a risk-free price, the price assuming with no counterparty risk, less a component to correct for the counterparty risk. So the latter component is often called as the credit value adjustment. Same for hedging also. Once I know what is my exposure with particular counterparty, I would first measure my exposure with them. Then in order to hedge that, I would be choosing a particular credit derivative, say a credit default swap. Then in order to, so what value of my credit default swap I need to buy to hedge my counterparty risk. So that through I can measure it through my CVA calculation. Okay, so let us take this topic further in a separate slide only. We will be having the CVA, the debit value calculation also, and the total value calculations also. So this is just an introduction of what is the credit value of adjustment. Basically, credit value adjustment is again uh, a measure to define the counterparty risk. So, so that's it. I think that's it from of the current topic. So if you guys have some doubt, some last minute questions, let me unmute you all. So any last minute questions, Rupesh and Sandy, Rupesh and Sandy.
No.
Okay. Okay, then we are good
Maybe.
to. Yeah, Rupesh, go ahead.
Yeah, it's Sandeep. Maybe
Sorry.
can we get some PPT notes or something like where we can go through all these topics once again, and if at all something required, definitely we will get back to you in the next class.
Right. Okay, we will be sharing you this video recording, this particular session.
Okay. Thanks, Anil.
Okay, Sandy, then we are good to close this session. Thank you, everyone. Thank you.
Yeah, thank you.